September 2020 was a particularly dismal month for investors. All three major US indexes posted their first monthly loss since the beginning of the pandemic in March. And the CBOE Volatility Index, often used to gauge the market's fear, spiked above 30 for the first time since mid-July.
I think this near-term period where we have not only COVID winter, but significant policy uncertainty about the United States, when you can't be certain who will be the president of the United States, what party will be in control, then you're going to have some elevated volatility.
The market typically slows a little leading up to an election and reacts more positively in the short term when a Republican president is elected.
The stock market and the political environment clearly are closely interrelated, and the stock market reacts generally to political news, and the stock market watches the outcome of an election and the presidential election in particular very closely.
Trump tax reform, tax code changes. I mean, I criticize aspects of it on fairness grounds, but the stock market looks at earnings, and that tax plan was a huge gift to corporate earnings.
Remember though, only 52% of American families are invested in the market. Long-term policy has a bigger impact on the economy than market performance. The economy has historically performed better under a Democratic president. The GDP grew 1.6 times faster on average, and private sector job growth was nearly 2.5 times faster on average under the Democrats. But the election can be an important element for those looking to earn big in the market. So how does the US election impact the stock market? And how can investors prepare? Historically, the stock market slows down and shows a weaker performance in the period leading up to the election. On average, the equity market showed less than a 6% gain during the election years, compared to an 8.5% gain in any other given year.
The stock market hates uncertainty, and of course, election is the ultimate in uncertainty. I think particularly after 2016, when people expected one result and we got a different result, or after 2000, when you had an extraordinarily tight race and you saw the market go down after that. These are reminders that this is a piece of uncertainty which you really can't minimize.
And that uncertainty and the fear of what is to come would generally depress the valuations, which would translate into potentially lower returns in the year before an election is to take place.
However, despite a more modest return, stock performances during an election year have done well. Across the last 7 presidential election cycles, average gains for major indexes like the S&P 500 and Dow Jones showed positive returns in the 6 months before Election Day. The only exception being the 2008 financial crisis that rocked the stock market right ahead of November. Despite the concerns over market volatility following the market performance in September, experts reassure that volatility is just something to be expected at this time of year.
The market will do well with a Democratic president, a Republican Congress, or a Republican president, a Democratic Congress. A great example of that was during Bill Clinton's time in office. Most of the time that he was there, he was dealing with a Republican Congress. Same thing for Barack Obama, had to deal with a Republican Congress for a good portion of the time that he was in office. And the market tends to like that gridlock atmosphere because they figure, you know, we don't really trust you guys anyway. And by having a split party thing, well, it kind of helps to make sure you guys don't break anything while you're there.
Whatever the result might be, a majority of investors do agree that the presidential election will have an impact on the equity market. According to a recent survey from Hartford Funds, 84% of investors said the 2020 election results will impact their investing habits.
I only see more uncertainty ahead just because the election is probably going to be close and the result is not going to be settled for quite some time. And so I would say the risks are definitely on the horizon for investors.
However, almost every expert unanimously agrees that placing stock bets based on politics isn't a great idea.
First of all, people are biased. People always think that their favorite candidate is going to be best for the stock market. Second of all, people think that they're able to predict how the election is going to turn out. And as we've learned in many elections, we really don't know. And finally, people think they know how the market's going to react when you get that election result. I know a lot of Republicans thought the market was going to go down when President Obama was elected. I know a lot of Democrats thought the market was going to go down when President Trump was elected. But in fact, the market went up both times. So if you're biased, you don't know what the outcome is, and you don't know how the market's going to react based on that outcome, you really shouldn't make an election bet.
The 2020 election is also likely to be very different from any of the past elections, given the state of the economy suffering from a national pandemic.
I think investors usually think about the economy as being the most important thing when it comes to investing. But the truth is that the fate of this economy depends upon the virus itself. Until we control the pandemic, we will not have a healthy economy. So I think as people think about investing, think about voting, the most important thing is how do you deal with the pandemic? Because if you can deal with the pandemic, get past the pandemic, then the economy will recover. And that should be good for portfolios.
The outcome of an election can have an entirely different effect on different sectors, making predictions for future market performances that much more difficult. The gridlock in Washington and the results could also have a different impact on the market in 2020, as many sectors are counting on more stimulus during the pandemic.
Healthcare is going to be huge in this election to just how the results will determine the future of that sector. It's anybody's ball game right now, but after the election is over, you'll see investors really start to put their chips on the table in terms of where they think the future is going to go.
Success will ultimately depend on how much risk an investor is willing to take.
And of course, the more risk-tolerant person will invest more in stocks and reap the benefits. And the more risk-averse people will perhaps stay more on the sidelines and potentially miss the gains as a result.
I think as an investor during a time like this, you want to make sure you've got your bases covered. So it really is some of the old time diversity, those kind of things.
Remember, any timing decision when it comes to investments really means you can make two good calls. You know when to get out and you know when to get back in. And I've never met anybody who can consistently make one good call on that. So I would think that the right thing to do is think about where you want to go in the long run. What are you trying to do with the portfolio? Think about valuations and place your bets accordingly. And try not to try and time investments around an election.